Traditional tax compliance requires an exhaustive accounting of every rupee. You track revenue, trace every minor expense, claim specific allowances, and calculate exact net profits to determine your tax liability. Section 58 provides a statutory override to this entire process. It nullifies the standard computation rules found in sections 26 through 54. This is deemed income. Instead of navigating a maze of deductions, Section 58 takes your gross turnover and applies a fixed percentage to find your taxable target directly. This target then splits into 3 operational tracks: general business, goods carriages, and specified professions. By bypassing standard bookkeeping, you trade precise computational accuracy for a massive reduction in compliance friction and audit fees. The first track covers general businesses run by eligible assessees, individuals, Hindu undivided families, or standard firms. However, limited liability partnerships are explicitly excluded. The statute also parves out a negative list. If your income comes from commission, brokerage, or agency work, you cannot use this pillar. Look at this logic tree defining the turnover limits. The standard ceiling to use this scheme is 2 crore rupees, but a higher 3 crore path opens up, strictly conditional on your cash receipts staying at or below 5% of total turnover. Crucially, receiving non-account payee checks is legally treated as physical cash, directly counting against that 5% limit. The system maps out 2 multipliers for your deemed profit, 6% for digital receipts and 8% for cash receipts. Let's process a business with a 2.5 crore rupee turnover. Their receipts split into 2.4 crore digital and 10 lakh in cash. Since cash is 4% of the total, under the 5% threshold, they clear the 3 crore conditional gate. Applying the 6% rate to the 2.4 crore digital receipts yields 14.4 lakh. The 8% rate applied to the 10 lakh cash generates 80,000 rupees. Merging the 2 outputs yields a final deemed profit of 15.2 lakh rupees. Under this dual rate system, maximizing digital transactions legally lowers your statutory tax rate. The second pillar covers goods carriages. To qualify, you cannot own more than 10 trucks at any point during the tax year. This graphic breaks down the 2 vehicle classes. A heavy goods vehicle is strictly defined as exceeding 12,000 kilograms in gross vehicle weight. For heavy vehicles, the deemed income formula takes the truck's weight in tons, multiplied by 1,000 rupees, multiplied by months owned. For anything 12,000 kilograms or lighter, the formula simplifies to a flat 7,500 rupees per month. Consider a fleet operating 2 15-ton heavy trucks and 1 light truck for a full 12 months. The heavy side calculates 15 tons times 1,000 rupees times 12 months for 2 trucks, totaling 3.6 lakh rupees. The light side takes the flat 7,500 rupees over 12 months for 1 truck, producing 90,000 rupees. Together, the fleet's deemed income merges to exactly 4.5 lakh. There is a unique exception in subsection 5 for this transport category. If the business operates as a firm, they are still allowed to deduct salary and interest paid to partners from this specific deemed income. By relying purely on asset weight and time owned, this pillar calculates tax liability entirely independent of fuel costs, maintenance, or actual operational expenses. The final pillar applies exclusively to specified professions listed under Section 62(4), such as legal, medical, engineering, or accounting practices. This diagram illustrates the gross receipt limits, a baseline cap of 50 lakh rupees, extending to 75 lakh only if cash receipts are under 5%. The math is straightforward. Deemed profit is assessed as a flat 50% of gross receipts. If a chartered accountant takes in 60 lakh rupees entirely through digital banking, they comfortably pass the 75 lakh limit gate. The gross receipts are immediately halved, establishing a deemed profit of 30 lakh rupees. Professionals on this track forfeit the ability to claim large overheads like office rent or staff salaries. You accept a guaranteed 50% margin assumption to eliminate accounting complexity entirely. Across all 3 pillars, subsection 4 strictly dictates that once you calculate income using these presumptive rates, no further business deductions are allowed. This chart shows the concept of deemed written down value under subsection 6. Depreciation is legally assumed to occur every single year you use Section 58, even though you aren't explicitly claiming it on a return. This phantom depreciation quietly erodes the book value of your equipment. When you eventually sell that asset, the gap between its shrunken book value and the sale price creates a higher capital gains tax liability. You do have the option under subsection 3 to declare that your actual profits are lower than the presumptive percentages. However, if you claim a lower profit and your total income still exceeds the basic tax-free exemption limit, you immediately trigger mandatory bookkeeping and a full statutory audit. Section 58 is a binding framework. Opting in determines your tax positioning and automatically alters your asset valuations moving forward. This timeline maps a strict continuity rule for general businesses under subsection 7. It creates a 5-year lock-in period that begins the moment you declare profit under the presumptive scheme. If you drop out of the scheme and declare profits using normal tax provisions at any point within that 5-year window, you trigger a penalty. You are banned from claiming Section 58 benefits for the subsequent 5 years and forced into mandatory audits for that entire period. High-turnover, low-margin operations extract the most value from this structure, bypassing the heavy audit costs that would normally consume their tight margins. But if your business relies on heavy asset depreciation or your cash receipts hover unpredictably near the 5% threshold, the presumptive track can become a liability. Presumptive taxation requires precise financial modeling of your operations and asset lifecycle before committing to the matrix.